Hello and welcome to the final week of reporting season and the final few videos for Bell Direct's reporting season coverage this August 2024. I'm Grady Wolf, market analyst with Bell Direct. In the final week of reporting season so far, we have seen 189 companies releasing results total this reporting season, with 57 beating expectations, 61 meeting expectations, and 71 missing expectations, as was expected prior to reporting season, given the high-cost, challenging economic environment of FY24. Some retailers have surprised to the upside over the past few days, extending on this central theme of reporting season, while the ASX heavyweights have released results that have caused a mixed reaction among investors this week. Let's dive into the big names of the reporting season results this week so far. Adore Beauty ASX ABY rose 5.45% on Monday after beating expectations with strong FY24 results against a challenging consumer spend backdrop. Over the last financial year, the company's expansion into physical stores through its recent acquisition of iCal added to the financial strength of FY24. For the year, Adore Beauty reported revenue rose 7.4% to $195.7 million, profit after tax of $2.2 million, up 487% on FY23, EBITDA rose 661% to $4.8 million, EBITDA margin came in at 2.5% in line with guidance, and the company boasts no debt with cash balance of $32.9 million. Active customers were a key positive of the results, with a jump of 1.6% to 814,000 over the last 12 months, and customer retention hit a record 64.7%. In terms of the outlook, Adore Beauty's current CEO, Tamala Morton, said the market conditions will remain challenging, but the company's growth strategy ensures it is well positioned to increase revenue, increase active customers, increase market share, and increase profitability. ASX newcomer Guzman y Gomez shares tumbled after the Mexican-themed fast food operator announced a larger statutory loss after reporting a profit in FY23. For FY24, GYG reported a 506.5% increase in net loss to $13.7 million. Network sales rose 26.4% to $959 million. Revenue rose 32.1% to $342.2 million. And the pro forma NPAT rose 94.1% to $5.7 million. The company opened 25 new restaurants in FY24 and have 91 sites in the pipeline as at the 30th of June this year. The start of FY25 has seen an uplift in sales though for GYG, with the same store sales growth of 7.4% for the first 7 weeks of FY25. Now, copper is the word for mining heavyweight BHP Group after the company released FY24 results, including copper production up 9% for the second consecutive year and is expected to rise a further 4% in FY25. For the last financial year, BHP reported revenues rose 3% to $55.7 billion, primarily due to higher realised copper and iron ore prices. BHP also reported a 2% rise in underlying attributable profit to $13.7 billion US dollars. Capital and exploration expenditure rose 31% to $9.3 billion US dollars, and net debt decreased to $9.1 billion US dollars, reflecting strong cash flow and proceeds from the divestment of BHP's Blackwater and Daunia coal operations. The 14% cut in the miners' dividend suggests it is reserving funds, though, for its pivotal copper acquisition strategy. Stronger online sales were the key driver of supermarket giant Coles Group ASX COL reporting a $1.13 billion profit in FY24, as outlined in results released yesterday. For FY24, Coles Group also reported group EBIT from continuing operations rose 5.7% to $2.057 billion. Operating cash flow jumped 98% to $3.598 billion, and an increase in the total dividend was realised of 68 cents per share being declared. CapEx increased in FY24, driven by new property developments and acquisitions, while net debt also increased to $1.501 billion. Shares in Coles rose 2% after the results were released. On the outlook front, Coles is expecting to reduce its CapEx in FY25 by almost $200,000, and the first 8 weeks of the new financial year have started strong, with sales revenue growth of 3.7%, while Coles liquor sales are down 1.4% over the same period. Elsewhere in the market of liquor and gaming, shares in Endeavour Group ASX EDV slumped 6.1% on Monday after the Woolworths spun-out company reported a profit miss, while EBIT and sales were broadly in line with market expectations. For the year, Endeavour reported group sales rose 3.6% to $12.3 billion. Group operating EBIT rose 4.9% to $1.1 billion. Group net profit after tax fell 3.2% to $512 million, and the full-year dividend was flat at 21.8 cents per share. The profit slide was due to an increase in finance costs, while the final dividend was 7.5 cents per share fully franked. The softer consumer spend market was also noted as a headwind against Endeavour, but the company's CEO, Steve Donohue, said the company's results demonstrated resilience in the challenging trading conditions. Mr. Donohue also noted that underlying sales momentum in both the company's retail and hotels segments has improved slightly in the first 7 trading weeks of FY25. Something to be wary of in this space, though, is the impact of the Victorian government's change to trading hours, that it may have an impact on the hotel and gaming division in this region for Endeavour. Investors shrugged off a dive in profits for lithium giant Pilbara Minerals ASX PLS on Monday to send the share price slightly higher following the release of the company's FY24 results. Up against a 66% decline in the price of lithium, FY24 was always going to be a tough environment for Pilbara Minerals to operate, with the company reporting sales and production had increased 16% and 17% respectively, but revenue fell 69% to $1.254 billion. EBITDA fell 84% to $538 million. Statutory profit after tax fell 89% to $257 million, and the company's cash balance declined 51%. Pilbara also secured a new $1 billion loan from Australian and international banks to fund expansion plans and support the finalisation of the offer of the takeover of that's worth $560 million takeover offer for Latin Resources. So what are the key findings for the final week of reporting season for FY24? Well, retail remains resilient and is surprising to the upside, with FY25 also starting on a very strong note. Retention of funds by cutting dividends is common across the board as companies either bolster cash to tackle the challenging environment that's expected in FY25 or to fund acquisition and expansion strategies. Online sales are a driving force for retail spend. Profits across all industries eased in FY24 as cost increase hit margins. And that's all for this week 4 reporting season update. Stay tuned for our week 4 reporting season wrap out on Friday. Happy investing.